Well, it gives me great pleasure now to bring on board Mr. Sunil D'Souza to talk about how quarter gone by has been for Tata Consumer, what is the way forward, and how should one read into this extraordinary surge which suddenly has come in the consumer demand. Is it real? Is it here to stay? And how the shape of the economy has changed in this environment. Sunil, fantastic to have you back and thank you for joining us. Let's start this interaction with a very big smile on your face. Brokerages have upgraded your stock. Everybody is now bullish on the good work you've done in a very short period of time. And for a stock which was almost unknown couple of years ago, now unforgettable brokerage reports and good things are coming out. Let's start with a smile, sir.
Thank you, Nikun. So if I can comment on the quarter gone by, you're right. We probably had best-in-class performance. Almost best in class, I would say, across various parameters, given the circumstances and given the uncertainties which we had to navigate, while also putting everything in place for the longer term with the integration of the food and beverage business. So revenue up 19, EBITDA up 26, group net up 31. I think margins, very healthy growth across, EPS up by about 33% in cash terms. All businesses, whether it is India Beverages, India Foods, International, everything has fired on top cylinder. We've seen margin expansion across all the businesses, excepting for India, where despite the galloping tea prices, I think we managed to maintain margins, which I think is commendable work by the team. Even the matrices, which, of course, I mean, everyone keeps pointing about, return on equity, return on capital employed. If I take minus goodwill, we are now at 19.5 unannualized, only for the quarter, 19.5 versus a 14.6. So significant improvement, yes. Are we happy with what we've done? Yes. But I think it's a long way to go. As I said, I think right now we're still focused on building the foundation for what is a phenomenal growth story, hopefully going forward. Right now on track on integration, synergies look to be ahead of track. The whole execution piece which we are putting in place with sales and distribution, logistics, warehousing, etc., more or less on track. We've completed 2 out of 3 steps on the S&D system without a hiccup, and that's what's led to this delivery.
If you construct the portfolio of Tata Consumer, and before it was Tata Tea, there was a branded component which had pricing power, and then there was a non-branded component which was always exposed to the vagaries of commodity prices, in this case which is tea. In the new definition of Tata Consumer, how much of a product completely insulated from what is happening to raw material prices?
So let me put it this way. I think right now we're still highly commodity dependent because there is still a large component of tea, coffee, etc., which is again moves along with commodity, but it's ability to build the brand and ability to drive pricing power, which I think will define Tata Consumer as we go forward. But if I step back for this quarter, I think what has actually happened is with the galloping tea prices, the plantation businesses have turned in a very good set of results. But a part of that has been offset by the weakness on the out-of-home businesses, which in my mind is short-term and it will come back. Starbucks, which we consolidated in our returns, and our Narishco business in India, which is out of home, and Empirical in the US, which is out of home. Those are the 2 businesses which are impacted. That said, if I step back on Starbucks, right now about 86% of stores are open. They're hitting about 71% of last year's numbers in the month of September. So all in all, the trajectory looks to be coming back and coming back strongly. Now on the branded businesses itself, I think that is where we are currently immensely focused on. And as we have maintained in the FMCG space, there are 3 big levers to play with. Number 1 is strengthening our brands. Number 2 is driving innovation. And number 3 is making sure we've got a robust S&D system, expanding reach. So let me give you some snippets of where we are on all those 3 pieces. Starting with S&D, as I said, we are well on track to integrate the food and beverage system. We've already delayered. We've already created common distributor, common salesman, and small initial results trickling in. Our distribution is now up by about 12% from where we started. And that is even without the whole piece coming into play completely. So from 2 million outlets that we used to reach, right now it's about 2.25, which is a good news. On innovation, we had consciously held innovation back. We've got a very healthy pipeline. We held it back, but we've started launching in October, post the September quarter. So we've launched Gold Care Natural. We've relaunched our Quick Chai. We are in the process of relaunching coffee. We've put an additional thrust behind Poha. We've launched new mixes. I think that engine will start firing big time now. And coming to the first part, which is strengthening brands, I think a tangible measure of that is when you take, for example, in the beverage space, you take share of handlers. And share of handlers is now narrowing vis-a-vis our largest competitor. We are less than 1 percentage point behind. And that coupled with distribution, I mean, can give us enormous traction as we go forward. The only other point I would like to make around brands is we've gained market share, both on our core categories of tea and salt during the quarter, both versus last year, same period, as well as the last quarter. So all in all, right now feel good about the traction on the India branded pieces. International also, we've had some good gains. Like I said, margins continue to go up. In Canada, now we've become leaders in specialty tea, which was the bugbear for us. That needs to now translate across other geographies. I do think the team is putting focus and we will turn in good sets of numbers as we go ahead.
How will you ensure that the Tetley overhang, I know it's an old acquisition, a legacy acquisition, not happened this decade, happened like 17, 18 years ago, will not clamp down your growth? Because the European tea market, we all know, is going through a challenge.
So let me put it this way. We've got a portfolio to play with. We've got India food, India beverages, and we're looking at newer opportunities in India. So India is going to be the growth story. This quarter, we clocked in at 25% growth on the India business, 32 in beverages and 13 in foods, which is commendable, even when you look at our peers and the numbers which have come out. So that part of the piece remains strong. And along with the integration, that will continue to deliver results. On the international piece, you have to remember it's a profitable business. It is a good cash generating business, and we've got strong positions. Like I said, we've defined very clearly which are our core markets, which is the UK, Canada, and the US, and we remain focused on that. We remain focused on driving innovation, A, and B, making sure we get growth rates up to speed. Like you said, I mean, when you talk about tea, if I split it into two pieces, there is black tea and then there is specialties, herbals, etc. While black tea, we have a good position and that market is softening globally, we have a huge opportunity on the specialties, herbals, etc. Focused on that, we've just launched Good Earth in the month of May in the UK, and initial results, and it's an exclusive at one retailer and it's done very well. So we feel very good about that. Canada, like I said, we were focused. We've got about a 40 share in black. We've now got to translate that equity into other pieces. And our super specialties are now, we are the number one out there. Same thing in the US, we remain focused on making sure, even within these categories, we are slicing, dicing to see where the opportunities are and driving it. All in all, I mean, margins good, top line continues to grow, and of course, it's a profitable cash business.
There was a big uptick in tea prices or local tea prices. Now, tea accounts for 40% of your total EBITDA, the Indian tea business. Now, you stated that you are migrating from being a commodity company to a product company, and that's a journey. It's not going to be an overnight transformation. So, in the short term, what happens as you are migrating? Because the surge in tea prices is something which is going to be a concern for you. What will be a strategy? Are you likely to take a hit on margins? Are you likely to come up with promotions, or you will continue to keep on passing on the hike in tea prices to your consumers?
So if I step back, the reason why these spikes have happened is primarily because of two reasons. One is the lockdown and the inability of the plantations to harvest tea during the early part of the lockdown. Then after that, in North India, there was bad weather, floods, etc. So we do think that this impact is up to the end of this financial year, possibly up to May, when the next round of cropping will start. So tea prices initially, I think in the months of August and September, were up by about 80%, 85% versus last year. starting to come down from those highs. They are now about 65%. We do think it will settle around 40-50% because there is still a gap between, if you take the full year from harvest start to end, there is a gap between the total demand versus the supply available. So that pressure will continue. Now, how much what, I think your guess is as good as mine. The critical thing for us is to stay close to the prices as the costs of tea as they move, and make sure that we are pulling multiple levers in our portfolio, both on pricing as well as other items on the P&L to make sure we are maintaining margins. Now, just to give you, I mean, I'm not a accurate forecaster for the future, but I can tell you how we've delivered this quarter. If you look at it overall, our margins on the India tea beverages business has been flat. So we have managed to, though gross margin was a little bit soft compared to last year, we've managed other items on the P&L to deliver margins, and we will continue doing so as we move forward. So there is price, there is A&P, there is other discretionary costs. We are getting savings out of the integration. So everything has to pull in together to make sure that we ride out this trend in the short term. But just as a perspective, while India tea prices are galloping ahead, Kenya has had record crop and prices there are, I would say, quite favorable for us. And that is translating into better bottom lines for our international business.
How large Tata Sampann could be in next 3 years? It's a small company. I mean, it's a small space, but a very large addressable market. I don't want to get into percentage growth here because percentage growth on a small base would be misleading. But what is your vision for Tata Sampann in next 3 years? How large that business would be?
So we've always mentioned saying that Tata Sampann is our diamond in the rough, and that is the one which will bear, I would say, disproportionate results for us if you focus on it. Pulses, we are the only national branded player today, and we are seeing enormous traction. You would see it in our numbers. It is outpacing all the other categories in the foods business. Spices, we are again probably one of the stronger now national players, and now we are expanding portfolio. Number 3 is mixes. I think we are sitting on a good trend of trust, convenience, hygiene, and the Tata brand name coming in there, and we are in a good spot. All in all, right now it's not, like you said, not a very significant part of the portfolio, but it's the growth that excites us. And I would say we would hit 4 digits very quickly.
Under your leadership also, you've not shied away from making strategic acquisitions, and you've not shied away from divesting strategic things. What would be your strategy on acquisition? I mean, which exactly is the product gap you would like to fill?
And 2 things I would say. As part of the 6 pillars that we've defined, explore new opportunities is a critical piece in the whole growth story and the algorithm that we've set out for ourselves. Now that is both organic as well as inorganic. So Tata Sampann, for example, is the organic piece. So we will deploy resources behind making Tata Sampann grow, both for the brand, for getting distribution, product portfolio, innovation, everything. On the inorganic pieces also, we're very, very clear. It is not that we are going out to the wide world and exploring anything and everything. Right now, we are a tea and salt player, now starting to grow our coffee, Sampann, pulses, spices, mixes business. And then we've got the out-of-home Nourishco. So we will be focused on making sure that we add in blocks in these pieces to make it grow. But beyond that, like I said, we are looking at becoming first a larger food and beverage company, and then a total FMCG company. So in the larger food and beverage company, we will look at adjacencies, and it's a constant scan out there. But the critical piece is to make sure that we are creating value for the stakeholders, and value in both strategic terms as well as in terms of financials. So categories which bolt in, my ideal state of affairs would be, we have created now a category-based structure where we've got a common front end with sales, a common back end for entire manufacturing, logistics, and infrastructure, and all the other categories are just plugins out there. So if I can leverage, if I can bring in any category on which I leverage my back end and my front end, then the entire gross margin which a category generates flows down to the bottom line, and therefore it is net accretive. So that is the kind of profile that we're trying to build as we build in adjacencies. Obviously, it has to pass our financial metrics in terms of return ratios, etc. So yes, right now, scan is out for both organic and inorganic food and beverage categories.
But what I'm trying to perhaps understand is that we keep on getting reports of Tata Consumer considering buying the coffee business or the office coffee business of CCD. Are you open to very large acquisitions, or you would just be looking at strategic fits? They both are directionally right, but what would be your intent? Look at small pieces of strategic fit, or go for something big and then restitch it in your balance sheet with synergies, of course.
So here's the thing. I think given the heft and the might of the Tata Group, I think anything that happens in the M&A space in India would definitely land up at the doorstep of the Tatas, and therefore it is then for us to make a decision on whether we're interested or not. So it is not that we are looking at A or looking at B. It is we are on a constant constantly evaluating opportunities, looking at them. So I wouldn't specifically make a comment because there is a lot of speculation out there. But I would say it is not that we are looking at small fits, we are looking at big fits. We will look at whatever creates value in the long run, and value both in terms of strategic as well as financial terms. So there is nothing that we are looking at. Yes, we will look at tuck-ins and bolt-ons, but it is not that we would not look at large transformational opportunities as well.
Okay. I want to understand what would be your outlook on your cash flows, because FMCG companies typically they throw a lot of cash flow. You are in a, you are going through a massive change, but at some point in time, markets in a shareholder will start comparing your return ratios and your cash flows with other companies, because your P multiple now is at a minor discount to other companies. When the P multiple was low, market ignored the ratios and market ignored the cash flow. But now if you need to command neck to neck with other FMCG companies, your ratios and cash flows will have to improve. When will that happen?
So Nikunj, it's a journey. It will not happen overnight. The whole thrust is along with the integration, along with the portfolio transformation, along with the execution mechanisms changing, we will start looking at additional cash. Just as a perspective, if you look at our cash year to date, I think we are about 500 plus crores, which we have generated. We're sitting with about 2,400 of gross cash, and we continue to throw up cash. In fact, to make sure that we manage our working capital well and make sure that we generate cash. If you look at last quarter, the difference between AR and AP, I think we've made significant progress. It's up about 380 crores, if I'm not mistaken. The only catch is because tea prices are going up and therefore the value of tea is going up. That is the only dampener there. But like I said, it is not going to be a long-term effect. It is going to be probably for up to the next harvest season for tea. So we've got to brace for that and continue to manage. But positive cash flow, yes, we have generated cash, continue to generate cash, hugely focused on the other parameters of inventory, AR, AP, everything. Making sure that the gaps are reduced significantly. I feel confident we're in a good place to continuously up the ante on that piece.
If I have to write a headline which says Tata Consumer's Vision Statement 2025, and let's talk numbers here, not pure statement of intent. In terms of return ratios and ROS and growth, what would that vision statement be?
I would go with a relative index on this one. I would say best-in-class return ratios and best-in-class growth company. And this is, I'm talking after 5 years, not even now. Now, I do think we have, at least in terms of growth rates, we are up there. But you're absolutely right. The return ratios have to improve. I do think we can get to a best-in-class by then. Among the top 2, top 3, FMCG companies in India.
You have ambition to become the best in class, but with your existing business model, can you really reach there? I'm asking this question again and again because a lot of your shareholders, some of them I know personally, they have taken a leap of faith with the view that your return ratios will dramatically improve. Can a commodity company morph to become a typical FMCG company which is dominated by brands? I mean, if you have to become what a Nestle does and HUL does, you'll have to create a lot of brands.
You're absolutely right, Nikunj. I would say you have to create a lot of sub-brands because we've got the Tata brand name behind us anyways, which is probably the most recognized brand name in the country. So we've got that, but we've got to create brands, A. B, we've got to diversify our portfolio. And C, we've got to continue to do the right things to bring it into best-in-class FMCG. And I mentioned that. I said we've got to invest behind our brands, power up our brands in terms of equity, drive up innovation and start expanding portfolios, start to be seen as the in-company that is there, best-in-class products, and of course, top-notch distribution. If I put that in perspective, right now we are focused on building those parameters and we've got cash on our balance sheet. So you will start seeing action on our expansion very quickly, becoming a larger food and beverage company. And automatically with that, I hope all the return ratios, etc., will start falling into place. Like I said, return ratios will not change dramatically in one day. I think what we are committed to is continue to move them north. And like I mentioned, we've already done, whether you look at ROE, ROC, I think last quarter we did that, this quarter we did that. If you compare it to the same period last year, we are starting to move the needle northwards.
Okay, just to wrap it up with one final question, we had Siddharth Lal of Aisha Motor just before you joined us on the show. And he said that I think India is going to move towards premiumization. But I always challenge this question with the fact that our per capita is stuck between $2,000 to $2,500. We are nowhere close to what China and other countries done. I mean, I hope we reach a per capita as high as China someday, but that is not happening. How damaging is that for a company which now wants to really build on the premiumization model? Because if your per capita is not increasing, it's a polite reminder for all of us that the reality is very different.
So Nikunj, the way I see it and I'll comment for the current categories that we play in, which is tea and salt, I see opportunities both at the premium end as well as the mass end. Right now, as you said we're stuck in the middle. If you look at even the way our brands are playing out in the categories that we are in, we are stuck in the middle because in the tea business, there is a substantial, about 50% of the market is still unbranded. So as GDP improves, the unorganized to organized shift will happen. I think it is accelerating right now with COVID. I hope that acceleration continues. But again, as a company, when I index to the other peers out there, as well as overall from an economic perspective, I think there is space to play on premiumization. So just for example, we've just launched Quick Chai, which is a 3-in-1, which is convenience, premium, just dunk it into a glass of hot water and you get the boiled tea taste, not the tea bag taste, right? We've done that. We've launched Gold Natural Care, which is again adding various immunity benefits on top of the tea. We've relaunched Tata Tea Tulsi. So that premium thing will continue. At the same time, the focus on making sure we drive the unorganized to organized, which is where we make money, I think that will also continue. Same story with salt. We have a 30% market share. We're probably the biggest player in salt in the country, but there is a huge portion of the market sitting below us, which is unbranded and unorganized and local players. I think as long as we keep focusing on moving them into the Tata Salt, we are in a good place. Again, Tata Salt, there is opportunity to premiumize with rock salt, black salt, fortified salt, low sodium salt. So that you will see a barrage of innovation coming out. I do think India is large enough as an economy today for us to address both the mass segment as well as the premium segment, and therein lies the opportunity for growth in the categories that we play in. That said, as we look at moving up our portfolio, rightly as you pointed out, we will look at moving beyond commodities and moving into the more branded and more premium spaces. We are not jumping in today for anything. We are carefully evaluating all options and making sure that they pass all the strategic and financial guardrails.
Your time. Stay safe, and a very happy Diwali on behalf of Team ET Now to you.
Thank you very much. It's a pleasure.